In recent years, the growing demand for energy by U.S. technology firms has resulted in a clash with the existing consumption patterns of Bitcoin miners. These firms, including tech giants like Amazon and Microsoft, are on a relentless quest for additional energy resources to power their expanding artificial intelligence and cloud computing data centers. This surge in demand is driving the most significant increase in power consumption the country has seen since the early 2000s, far exceeding the pace at which grid capacities are being expanded. As AI and cloud technology continue to proliferate, the need for reliable, large-scale electricity sources becomes even more critical. However, this need is met with a substantial obstacle: the significant energy consumption of Bitcoin mining operations. Bitcoin miners utilize vast amounts of electricity to power their computational processes, essential for validating transactions on the blockchain. This intense energy consumption creates a direct competition between cryptocurrency operations and technological innovation sectors. The technology firms' aggressive pursuit of energy resources underscores their urgency to support their data centers, which form the backbone of their services. These data centers not only facilitate AI advancements, but also provide the infrastructure for numerous online services used daily by millions of people. As the demand from these centers continues to escalate, it poses a stark contrast to the backdrop of traditional energy infrastructure development, which has not kept up at a comparable rate. This divergence highlights a critical challenge: balancing the energy needs of cutting-edge technology development with other high-energy industries like Bitcoin mining. Both sectors play influential roles in shaping the future economic landscape, yet their coexistence strains the current energy infrastructure. Consequently, the competition for energy resources between these technologically driven fields represents a significant hurdle that the U.S. must navigate to ensure sustainable growth and innovation. The fierce competition for electricity is having a profound impact on the energy-intensive cryptocurrency mining sector. Some miners are adapting by leasing or selling their infrastructure and power connections to technology firms, while others risk losing access to the essential electricity resources critical for their operations. Greg Beard, CEO of Stronghold Digital Mining, a publicly traded Bitcoin mining company, notes that the battle for AI dominance involves the world's largest and most well-capitalized corporations, who remain deeply invested in securing victory. These companies prioritize operational continuity over the cost of electricity, underscoring the high stakes of this competition. By the end of the decade, data centers in the United States are projected to consume up to 9% of the nation's total electricity supply, a significant increase from current levels. This surge is driven by substantial investments from technology firms aimed at expanding their computing facilities, as highlighted by the Electric Power Research Institute in May. Globally, data centers currently represent approximately 1% to 1.3% of total electricity consumption, while crypto mining accounts for about 0.4%, according to the International Energy Agency. This gap is anticipated to widen further in the coming years. Navigating the transition of electricity supplies and infrastructure from crypto miners to technology firms poses significant challenges, according to industry insiders. Many Bitcoin miners announcing plans to pivot to AI lack a clear understanding of the complexities involved, remarked Zach Bradford, CEO of CleanSpark. He emphasized his company's commitment to remain focused on crypto mining, citing the shorter construction timelines, 6 to 12 months, compared to the 3 years required for advanced data centers. Adapting existing Bitcoin mines for AI or cloud computing would necessitate substantial investments in specialized cooling systems and infrastructure, Bradford noted, highlighting the financial hurdles faced by crypto miners, especially following the 2022 Bitcoin price crash. Sergey Gerasimovich, CEO of Easy Blockchain, echoed concerns about access to capital, noting a project setback with a South Carolina utility that opted for a larger-scale AI company, underscoring the dominance of hyperscalers in the market. These global technology giants operate extensive networks of data centers and cloud infrastructure, leveraging substantial financial resources for rapid deployment. Gerasimovich emphasized the competitive advantage of hyperscalers, driven by their agility and significant financial backing, posing a formidable challenge for other industry players. Industry analysts project that by the end of 2027, approximately 20% of the power capacity currently allocated to Bitcoin mining operations will transition to support artificial intelligence initiatives. Over the past year, executives from several prominent U.S. publicly traded crypto mining firms have observed an escalating competition for the same power resources and agreements with AI data center operators, according to insights shared with Reuters. Marathon Digital Holdings, recognized as the largest publicly traded Bitcoin miner globally, expressed interest in acquiring a nuclear-powered data center owned by Talon Energy in Pennsylvania, sources familiar with the matter disclosed. While Marathon acknowledged a readiness to discuss potential data center acquisitions, it did not confirm specific interest in the aforementioned facility. In contrast, Amazon recently completed a transaction in March to acquire the facility, securing a power capacity sufficient to energize nearly all households in New Mexico, leveraging its vast market capitalization. Significant interest is emerging among major miners who possess land and power infrastructure, prompting a strategic shift away from exclusive cryptocurrency mining towards offering their properties and energy services to AI and cloud computing enterprises. We have received substantial interest from entities such as Amazon and Google, remarked Carrie Langley, Chief Strategy Officer of TeraWulf, a Bitcoin miner with a facility capable of generating up to 770 megawatts (MW) in upstate New York. The surge in tech sector interest began in June, catalyzed by Core Scientific, emerging from bankruptcy, announcing pioneering agreements to lease their power-connected facilities to CoreWeave, backed by NVIDIA, valued at over $6.7 billion over 12 years. Subsequently, several miners have expressed intentions to lease their facilities or collaborate as subcontractors in developing AI data centers. Modern data centers, traditionally around 20 megawatts, are now scaling up to 1,000 megawatts. However, connecting new power supplies in the United States involves wait times spanning multiple years. For crypto miners possessing substantial energy assets, diversifying towards AI and cloud computing could increase the value of their facilities by up to fivefold, according to Morgan Stanley research. The acquisition or leasing of space from miners with at least 100 megawatts capacity can expedite data center launches by approximately 3.5 years, resulting in significant cost savings amounting to billions for technology firms, as indicated by Morgan Stanley.